My business makes, well, it's on track to make about 300K this year, 2024.
How do you do it?
So Tepper is a B2C SaaS. We serve the retail investor and help them invest with confidence. Our business model, just to be transparent, we're a screener, an educational platform all in one. People come to us looking to understand, hey, is Tesla a good stock? Is Palantir a good stock? Is Apple a good stock? We have about 40,000 stocks, about 1,600 ETFs, and we even have crypto. And then we've got other tools in a platform like a watch list tool that keeps track of stuff for you, portfolio tracker, alerts, and then everything education-wise, so you know like when to buy, when to sell, how to reduce risk, and everything in between. So we're basic B2C subscription platform, and that's how we make money. Our plan, we'll get right to it. We're a 14-day free trial, no credit card, and then people can upgrade to the base plan, which is either $15 a month or $99 a year. Majority of the people go with the yearly option because you save 3 months.
Yeah. You also have an education arm on that as well, right? With software?
Correct. So our main SaaS platform is Tepper, and then we do have Tepper EDU, which is, we phrase it as a nice to have, not a need to have. But if you want to get into courses, we got 3 different courses. One is stock investing for beginners. It's 60 modules, 10 minutes or less that are really to the point. Then the second one is how do I use Tepper? It's like looking over my shoulder and showing you how I use Tepper in every way possible. The third course, since you're a real estate guy, you'll appreciate this one. This was how to create passive income with options trading. We use covered calls. That course actually is in production as we speak, should be going live in early April, but that's been in high demand. So yeah, people can go with those. And then I do offer limited time basis, one-on-one coaching, but I only can take on a few clients at once. And we're actually almost booked up.
So you said passive income, and my ears perked up here. So is that something that you just sit and let it go?
Pretty close. So take a step back. Investing in the stock market is very passive. If you're using a tool like Tepper, because it does a lot of heavy lifting for you, you really only need to use it maybe 15 to 30 minutes a week if you really wanted to, because it really analyzes stocks in seconds. Hey, is this stock a good stock? For example, Tesla or Apple, Microsoft. But with passive income, with stocks, you're not really creating passive income because you're using compound interest in building your portfolio. You don't really want to take money out of your investment account until you achieve financial independence or retirement. So it's not really creating income. However, there's a strategy called covered calls, selling covered calls, and how it works. I'll keep it in simple terms. What you do is you need to own one contract, which is 100 shares. Not every stock has an options contract attached to it, but I'll use an example like Caterpillar or John Deere. You can buy 100 shares, one contract, and then what you do is you sell a contract 30 days out at a strike price. Let's say the strike price is $200 or the share price is $200, strike price is $210. If the stock goes to $210, you sell for profit. If it misses the strike price, even if it goes down, you collect premium. So no matter if it goes up or down, you make money. And it's a rinse and repeat strategy you can apply every month. In the course it gives you all the tools, the training. I've got an Excel sheet, but you really only need to use that Excel sheet and Tepper maybe 1 to 2 hours per month. And you can be making about $500 to about $2,000 profit to start out. And then of course you can dial it up from there.
Is there a limit on that end? On what
No limit at all. If you want to own as many contracts as you like, that depends on how much money you have. You got to go minimum 1 contract, but you can go unlimited. You could buy 10 contracts, but then you're going to be putting in several $100,000. But in that case, you could be making tens of thousands of dollars per month.
Do you personally get into things like that?
I don't with options anymore. The reason I have multiple streams of income, number one being Tepper, my SaaS. So every bit of money that could be used for options has been applied to building the business, just because the ROI is significantly more with a SaaS business. However, I do continue to invest in the stock market. One should never stop investing in the stock market, like using compound interest. Seriously, eighth wonder of the world. There's no way. Like my favorite case study, I'll share it really quick, is a janitor by the name of Ronald Reed, who built up a portfolio of $8 million. The question is, how does somebody who's making minimum wage become a multimillionaire? The answer, hold about 10 stocks or less, really strong stocks, value stocks, and then keep buying every single month. You can't skip a month. It's discipline. Got to buy every month. And that's seriously, when you do that over 5 years, 10 years, 15 years, it does some incredible things. I do consulting as well. I won't get into that, but ticker, yeah, no more options. You have to pick your battles. And I'm like, the the multiple, and we could get into this on a SaaS business can be very high. And eventually I do want to sell. We are getting offers all the time to sell a company, but it's not at the price I know I can get.
Yeah,
So it's keep driving this thing forward. And it's fun. This is my dream. I love building this business.
I love it. To attest to that too, more people I talk with that are investing and everything. The younger crowd goes for the more aggressive, the higher returns. And then I've noticed the wealthier, older class they're all about preserving their wealth versus making wealth. So they go for the lower, less risk, guaranteed returns. And that kind of sounds like what you're heading at right now.
So ticker, yeah, I'll define the difference here. We guide people into really two different paths. You're either in wealth building mode or wealth protection mode. Wealth building mode is when you're still working. You've got a timeline to achieve financial independence or retirement. Could be 5 years, 10 years, 15, 20 years out. In that case, you want to be in individual stocks. That's where you get those returns. No promises here, but our returns are usually, you can earn between 15 and 50% per year. The market average is about 6 to 8% after inflation. So you can beat the market pretty easily by using ticker. So if somebody's still working, you want to be in individual stocks. But as you alluded to, as you start getting to a point when you're nearing retirement or financial independence, let's shift your portfolio more to wealth protection mode. And that's when you should be looking at ETFs, index funds, or mutual funds. They're pretty much the same product, except for mutual funds have a higher cost, a higher expense ratio. We could talk about that. But those are essentially a bundle of stocks, could be between 100 and 1,000. And you're really just going to match the market. Don't split hairs on this. Some people are like, I'm thinking about this, yep, and then it's stop it. Like they pretty much generate the same returns.
Yeah.
In that case, your objective is not building your wealth, it's protecting it. You'll ride up a little bit, you'll ride down a little bit. Don't worry about it because it's just keeping your money safe, but at the same time, outpacing inflation. Because I always tell people, you want an emergency fund about 3 to 6 months in your savings account, but don't put any more in there because you're not doing yourself any favors. Your savings account is not going to beat inflation. So anything over 6 months, I'm like, yeah, put it in your investment account, let it work for you. Otherwise, yeah, I see too many people sitting on too much savings. I'm like, yeah, it's become less valuable every day. Yeah.
Yeah, for sure. How'd you get into investing?
So I built my first company in the 2000s. It was an agency. We were building websites, custom software. We even did some video services. This was between 2006 and 2010. I made like no money. It was a very low profit margin model, a service business. I had a lot of employees, payroll, taxes, all that kind of good stuff. But then in 2010, we were approached by a larger agency. They offered to absorb us or pretty much buy us out. Now, there was no check written, like $1 million check. Hey, Sean, you just sold your business. It was none of that. It was all debts and liabilities wiped clean. So a lot of your entrepreneurs probably know this. Service businesses typically have a very low sale multiple, if no multiple at all. It's very hard to sell a service business. And I learned that in my 20s. I'm glad I did not learn that in my 60s. So after that, I'm like, okay, I got to figure out, how do I flip the equation so I'm not working for money entire life? I get money to work for me. And I immediately gravitated towards investing. And I actually got into more risky investing, which is angel investing, using my money to invest in private companies. Very risky because you don't have a proven business model, product market fit, customers, momentum, the whole deal. So I did that for a few years. Then in 2015, that's when I got focused and looked at Warren Buffett and Charlie Munger and said, okay, these guys are doing something right. They are billionaires. What are they doing? And I knew they were able to beat the market consistently, yet we know, you and I both know, and your listeners know this too, these are not gambling men. They don't use emotions or feelings, and they're not sitting at the casino, right? So that means they're using some sort of logic. Now, my background, so over 20 years now, is primarily tech. I've done not software engineer, but I've been a project manager primarily. And I've worked for some large companies like Kohler and GE, great companies. But anyway, I used my tech background to create an Excel sheet. I gamified it with a point system from 0 to 100. So I know like definitively, is this stock a good investment? Like Palantir or Microsoft or Tesla or whatever. I didn't want to be in this waffling area where so many people on Twitter and Reddit and YouTube, I don't know if it's a good stock. And like, you got to cut through the clutter. So I used that sheet for about 4 years, making returns between 15 and 50%. In fact, it was closer to 50%. Then 2019, I started sharing this Excel sheet with a few people, and everybody was like, when are you going to turn this into a software? And my dream was always to create a SaaS business. This is a topic for another day, unless you want to go there, but I had a few failures from 2010 to 2020 that I kind of side hustled, and I learned a lot, but there were always some kind of SaaS, but this was it. I'm like, this is a SaaS that can really gain some traction. And yeah, it took about a year to build, went live in 2020. Took about 6 months to get the first paying customer, which was a very humbling experience, but I know this is the journey. When you create a SaaS, you don't want to look for paying customers right away. You want to get people into the platform for free, get fast feedback, and put that into play and make the tool what they want, because it's not what you want, right? Your software is always going to evolve to something different. I built enough software by this point, so I knew that. So yeah, and to fast forward from 2020, 21 to today, 2024, we just crossed 9,000 customers over about 50 countries. So finally feel like we have momentum, but it was a hell of a journey.
It sounds like it. Dang, that's a lot. There's a lot that you touched base on there. Back to the investing side, before I lose my
Sure.
train of thought. What would you say your favorite investment is?
Because I know tech really well, and that's my specialty. I like strong tech stocks with multiple streams of revenue. We have a tool built into Ticker called the 4M analysis, or 4M confidence booster. I'll keep it really short here so I won't talk your ear off, but we look at more than just the numbers. You see too many people on Wall Street, they'll like look at market cap and PD ratio and be like, that's a good stock. You're missing a few steps here. So we use the 4Ms. The first M is the margin of safety, or the math part of investing. The second M is the meaning. That's the business model. How many revenue streams? How scalable are those revenue streams? The third M is the moat. How does the business stack up against other companies in the same sector and industry? And then the last M is the management. That's a track record of the CEO. We look at everything. If you can get a really high 4M score on a tech stock, count me in, because your returns, you can kick ass. You can beat the market by a long shot. Like me at this point in my life, like I can confidently, barely even using Ticker, an hour a month, I can get 50%. I believe I can consistently make, I'll put it this way, between 25 and 50% every year, no problem. Just because the tool has increased my confidence enough, and I know how stocks behave. So I could do this all day.
How much involvement is that to gain double-digit returns like on your end?
Not much at all. Like I said, I'll put it this way, going back to that janitor I mentioned, the guy, Ronald Reed, he found a few strong stocks and then he'd buy and buy more. See, the biggest problem, and a question I'm frequently asked is, when somebody buys a stock, their very next question is, okay, when do I sell it? And that's the wrong attitude. That's the wrong mindset. You got to be thinking about, okay, so you just found a strong stock. You got to commit to it for the next 10 years. In some cases you will, some cases you won't, but you have to be buying more. So I see too many people making the mistake of buying and then selling, or buying too many stocks. They'll have, okay, so they'll get to 15, they'll get to 20, they'll get to 25. What you're essentially doing is creating a fund, an ETF, and you're not going to beat the market. So it's got to be focused portfolio, 10 to 15 stocks. I hold 10. And if people are interested, they can see my portfolio when they join Ticker, just so you can see what I'm in. But it's actually really simple. Too many people out there over engineer investing. And it's unfortunate. Probably in your space too, as real estate, people overcomplicate things, and it doesn't have to be that way.
That's so true. As long as you're buying in the red and selling in the green and not the opposite, you're going to make money.
Seriously, we've got a rule. This is a rule one. This is Warren Buffett's rule one investing. Rule one, don't lose money. Rule two, don't forget rule one. So the principle there is, when stocks go down below your cost basis, you do not sell. You let the market ride them back up, which it usually does. A rising tide lifts all ships. I stole that from Motley Fool Money. Great show, by the way. And that's the principle. Like, when stocks go down, don't stress out. They're going to lift back up. And I've done that a few times in my past. And I just wait maybe 3 months, 6 months, 9 months, and then I'll sell for profit. But I refuse. I'll tell you right now, I do not lose money in the stock market. because I made that choice. I do not sell for a loss. I only sell for a profit.
Absolutely. Go broke making a profit.
Amen.
To that, are you more so investing every month and putting it like behind you on auto draft, or, and you probably did this as well, but are you looking for those bloody days to go in heavy on a single stock?
Brilliant question. Okay. So in our onboarding, when people join, they get a series of emails. And of course, we show people you can read them all in one go. But there are a few emails that teaches you this. And what you want to do is, this is really important strategy. You want to set up an auto draft from your bank account to your broker. I use TD Ameritrade in the States. I always say States because we've got customers all over the world. So I can always list brokers in other countries, but auto draft. So it's automatic. You got to treat it like your mortgage or rent or your energy bill, your cell phone bill. You cannot skip. You cannot pause that. You got to be sending money to your broker every month. And then it's going to sit there in cash. And then what you do is this: put 50% of that in your broker aside, and you save for what's called stockpiling. Stockpiling is the number one most important strategy an investor can use. That principle is, when the market goes down, you want to buy into the dip. You can't time the very bottom. No software or human being can do that. But when the market pulls back like it did in 2022 and part of 23, we had the recession. You want to buy into that, usually every 5 to 10% down. So that's stockpiling. You got to wait for those events. You're going to be saving up some cash, which is a good thing, but you want to be ready to attack. The other 50%, you DCA, which is dollar cost average. Every single month, you should be investing into the same stocks you're already hold until you get to about 10 to 15 stocks in your portfolio, and then you stop. You don't need more stocks. You need to buy more of that which you already own. You keep doing that. But yeah, like now we're on a big tear in the market because we are coming out of the recession. Same thing happened in 2009 and 10 after the housing crash. So if you ever hear people talk about we're going to have a recession in 2024, I'm like, no, we're not. Like, we just went through one. Shut up. Yeah, in history, and I've done studies over the last 100 years, you don't have back-to-back recessions. That does not happen. The fear is what happens, and then the news perpetuates that. So people just sit in cash, which is stupid. Now you want to be investing and let that ride up. Now, if we see a small pullback, then you can deploy your capital. And that, when it corrects, which it always does, that's when you make the big return. Stockpiling again, that's the big play. But the biggest thing you need, like Dylan and your audience, it's not your intelligence and it's not your math skills. You don't need it in that. It's your ability to control your emotions. Because guess what? The market's going down. Everybody's freaking out. Everybody on Twitter or Reddit or on YouTube is, oh my gosh, the sky is falling. You got to be stoic. You'd be like, guess what? I'm holding strong businesses and those businesses are not slowing down. So guess what I'm going to do? I'm going to buy more when the market corrects. That's when I'm going to make a lot of money. I'll give you another case study here and then I'll shut up. I got a buddy of mine. He's a plumber. When he was in his younger 30s, he had $100,000 saved in 2008 market crash. And there were the bailouts of the auto manufacturers, GM and Chrysler. But there's one auto manufacturer that did not ask for a bailout. That was Ford. Guess what he did? He bought into Ford because the balance sheet was that strong. And he turned that 100K into about 2.5 million in about a year and a half. Is that's stockpiling. And you won't get those you'll get small stockpiling opportunities through the duration of a year, maybe if you're lucky, but the big ones don't happen often. For example, it was 2008 was the big one. Then you fast forward to 2020, the COVID dip, when things went down 30% for about 3 months. And then from after that, it was 2022 and 23. So I'm putting cash aside. I'm still investing, but I'm like, when is the next one going to happen? I don't really care, but when it does, I'm going to be ready. Like, I want that market to just tank 30% or more, and I'm going all in. And that's when I'll make a ton of money.
When do you foresee that? Like you just said, that was my next question I was going to ask. What do you see in the markets since we just went through? I know we'd say, just like you said, we just went through one and we're coming on the other side of that, and our numbers proves that. I even looked this morning at the market over the last year. We've been, since 2023, if you look back a year, your NASDAQs and everything, I think I saw 32% or something over the last year.
It's incredible.
Yeah. What When do you see the next pullback or correction?
So you got to look at triggers, signs that can cause that. Now, to go back to 2022, there are three definitive causes of this. The big one was inflation started taking off, and it went up to, in 2022, it went as high as 9%. The last time it got that high was in the early 80s. So that was number one. And what really accelerated that just happened before that was two things. One would be Russia and Ukraine, Russia, Putin talking about invading Ukraine. Context there, when there's rumors of something, the market goes down. But when a definitive decision has been made, for example, 9/11, there was about a 2-week period after that where the market went down. But as soon as George W. said, we are invading Afghanistan, it was a definitive decision and the market started taking off. To go back even further, JFK assassination, the market went down one day because we caught the guy. We got the guy. So it's like the same thing with the guy that shot Reagan. Reagan didn't die, but it was like, oh my gosh, people freaked out, but we got the guy. Okay, market took off, so market went down a day. So just keep that in mind. When there's rumors, the market goes down, and those rumors went on for 3 months, and the market started falling off a cliff a little bit. Then we had the Omicron variant, COVID, and then the third thing was inflation, and that's what really took us into the recession. Now, fast forward to today, we're at 3 points on my other monitor here, 3.1% inflation. You want to be sitting between 2 and 3. So we're in a great spot. Like 3% that's pretty good. So I talked about inflation. We want to look for the signs of like when will there be another recession? When will there be a crash? And it's like, all right, so it's not inflation. We're good there. Housing, interest rates, they're kind of, they've been flat for a while, but nothing's spiking there. I see 6.94% as of today. Not perfect, but it's like still an improvement over, I think it did get up to 7.3 as I see in the last year. So it's like, all right, so those are good signs. What else could trigger it? I don't really see anything. Like if another COVID variant comes, we've been there, done that. The world was prepared for that. So that's not going to be a shock. It would have to be a rumor of another war, but that can impact the world. Like that would be the next thing I can think of, but I don't see. Some people say, what about the debt in the US? Debt has never triggered a recession. You just keep printing more money. What happens there is you keep printing more money, you go into more debt. What it does, it can drive up inflation. Now, if that gets out of hand, we could see what happened at the end of 2022, beginning of 23. So I don't see any signs. When I see these people on Wall Street talking about, hey, we're going to have a recession in 24, I'm like, no, we are not. This is going to continue to rise. Now, if it, again, small pullback, take advantage of it, but I don't see any big threats.
Yeah. I honestly feel like we got them good at the triggers and taking the right action so we don't hit those.
Correct.
I feel like they're actually getting pretty good. I hate to say with the rate hikes and everything that they've done, it's actually helped a little bit though. I feel like they're figuring this out.
100% agree with you. A good example of that is Jerome Powell, the Fed chair, did talk about increasing interest rates a little bit to continue driving down inflation so we can get it in that 2 to 3 range. People freak out about that. I'm like, good. Like we're going to see some nice little pullbacks, but it's not going to crash the market. And it puts us in that inflation range we want to arrive at. Now, you're right. What you said there, we are getting smarter because we went from 2009 to 2020 years without a recession. That was a long stretch. You take a step back, Australia went over 30 years without a recession. So as time goes on, you do get wiser to the signs. You know how to get ahead of them, or you like to think the right people in charge can get ahead of it. Not always, but they are getting better. So I think we're in a good spot.
If you couldn't invest in stocks anymore, what would be that other investment?
Entrepreneurship. My main investment is actually one stock at this time. It is Ticker. The way we're building this, I've worked for a few public companies or large companies. I'm running this. How would the scrutiny be if you have to report to a board of directors with your financial statements or your marketing plan or everything you're doing? You need to be airtight with that information and that language. So I'm running Ticker as if I were still working in a public company. And people have asked, hey, would you take Ticker public someday? And I would love to, but it takes a lot of work and a lot of revenue and a much bigger team to get there. But I'm confident I can get there. But if it does sell at some point, great. But yeah, if I didn't have Ticker, to be honest with you, I've got like a list of other business ideas that probably execute it.
So we can definitely go. So I'm a big visionary. And right now I'm in that kind of space of what's the next business I'm going to start or buy. I'd love to talk with you more about that at another night.
Sure.
What's your top investments right now? Like your top stocks?
Yeah, I'll break down a few of my favorites. So I do invest in the usual suspects. I love Microsoft. I'll give you the top 4 or 5 here. So Microsoft, Apple, Google, Palantir, and Fortinet. And I'll give a quick reason why. Microsoft, I consider the perfect business model. Now, it has not been the top performing stock compared to NVIDIA over the last few years, maybe a few others, but it is the perfect business model. The reason is it has B2B SaaS, B2C SaaS. You've got Microsoft Office, which is used by most corporations around the world. And when a company starts talking about cutting budgets, they will never have a conversation, hey, we should get rid of our Microsoft Office 365 licenses. That will never happen. It's like the stickiest software on the face of the planet because everybody needs it to run. They've got ERP solutions, Dynamics, which gets into more enterprise software, which is more my background. Then you've got Xbox, you've got Windows operating system, list goes on. So the number of revenue streams is profound. And I think they've acquired about 200 companies over the last 40 years, which turned into new products or new revenue streams. So that's one. Two, I really like Apple because, again, they've acquired a lot of businesses. They have a lot of revenue streams and huge brand mode. Like when people move to Apple, they typically don't switch back to PC or Android. I know I was that case. I was a case study of that in the last few years. It took me so long to switch to Apple. Finally, Sean got with the program. So I really, Apple, they're great financials, of course. Google, I will say this because I researched, worked in a lot of businesses in the past. The most scalable business out there is probably ad tech. Second to that would be fintech. Third would be SaaS. With ad tech and fintech, you don't have limitations on how much customers pay you, whereas SaaS is a set fee every month. Yes, very scalable, but think about a company like a retailer doing advertising on Google and YouTube. They can be spending $100K this month. They can see results, dial that up to $200K. Next month, go to $300K. There is no limit. It's huge revenue. But then fintech, think about payment transactions like PayPal or Square. When you come between the buyer and the seller and create a low friction solution that people barely even notice, but you're taking fees, that is also highly scalable. So I really like Google for that case. Moving on to Palantir's enterprise software, data analytics, which is very boring, but very much needed. And they serve both military, like the US Army, for example, and then they serve large corporations. And then number 5, very few people have heard of, Fortinet, cybersecurity. Same situation as Microsoft. Every company out there needs cybersecurity software and they're enterprise level. So when you're enterprise software, you're charging customers hundreds of thousands of dollars and up to millions of dollars per year. It's not some like baby SaaS like Ticker where you're charging $100 a year. We're B2C. I can make fun of my own company. But when you go to play in the big boys playground with enterprise, it's a whole different ballgame. And Fortinet, they're like best in class with cybersecurity. They got a lot of big customers.
So those are the 5.
Those are, top 5. I got a few others, but
you can. Are those the ones that are you able to see? You said you're able to see your picks on Ticker, right?
Correct. Yeah. And you can see my allocation percentages. Give me a second here. I can actually give you the full list. And then I can let you know what move I'm making here soon because I'm going to be selling and moving into other. Right. So I do have PayPal. PayPal is not a big performer for me over the last few years. And when the recession hit, they really took a nosedive. But rule 1, don't lose money. Rule 2, don't forget rule 1. So I will not be selling that. I have high conviction for PayPal for the long term. Though they've got a ton of revenue streams in their models. So I really like that. I also hold Square, very small percentage there. Like PayPal, it's fintech, transaction fees. I do hold AMD. I like with semiconductor stocks, you got AMD in the top of the class right now, and everybody's talking about NVIDIA. Both are solid. I do hold Paylocity. They're HR tech, so payroll tech for large corporations. Then the last one is Atlassian. Atlassian is a tool like Jira and Trello. Software engineers use it. Not the best financials in Ticker, but the 4Ms really do collectively check out for me. But I plan on, so the audience knows, I'll sell this year I'm going to sell Atlassian and Paylocity. Reason is competitive landscape. It's becoming saturated with both. So I'm thinking ahead. Hey, if you got a lot of competitors, just be aware of that. Yeah, I'll cut those two positions. At some point, block as well. I think they could be doing a little better. But anyway, I'll stop there.
Cutting those, are you still getting good returns even on that? Because I know you're not selling at loss.
Absolutely. I'm in the positive for all three. And what I'm doing now is when you're in a position where you want to sell, you can be saying, just wait a little longer, just wait a little longer. And it's, you know what? Opportunity cost, cut your positions and move on to other stocks. And what I'm identifying, I'm looking at a stock called Nova. Nobody's heard of this one, but what they do is they help with the manufacturing process of semiconductor chips. And they've returned about 500% over the last 5 years. Huge stock there. And I'm also looking at Intuit. Like, for example, in the States, you have to pay your taxes. They've got QuickBooks, they've got a suite of tools with them, but you can't not pay your taxes otherwise. You're gonna have issues. So I like anytime you have a product that's mandated by law, that's a good place to be. Like insurance, I don't have any insurance stocks in my portfolio, but I do like insurance. Unfortunately, it's a commodity, but insurance, like you have in the States, I think it's required in almost every state, homeowners and auto. If you don't pay, you got yourself a problem.
Are there any of those? I know that you're more of a value investor, but are there any of those? And you said you also dabbled in angel investing too. So you've probably seen the upside of the smaller companies and 100% return over 5 years. Do you allocate money to those kind of younger companies or stock picks that you watch in the background?
Actually, with our onboarding, we do teach people about penny stocks and IPO stocks. And to answer your question there, I do not. Like the one risky stock I invest in is Ticker. It's my own business. I don't consider it a risk because I'm running it. But if other people were looking at it from the outside coming in, they'd be like, oh gosh, that's a penny stock. I'm not touching it. Unless they get to know me, then they may consider. But otherwise, no. The answer is, and this is really good for your audience to know, we teach people that a penny stock is anything that is $5 or less US dollars. And anything that hits that range, there's a 99.9% chance it will never break out past $5. The reason is large institutions lose interest. They lose confidence, they lose interest, and they move on to other stocks with a higher market cap. So that's no-go territory. Now, anything that's between $5 and $10, there's a 90% chance it will never break out past $10. Same situation, large institutions lose confidence. So we do tell investors, wait for stocks to go above 10 to start getting confident. Unfortunately, I see too many people kind of like the Dogecoin situation. We're going to get in at 3 cents and watch it go to $5 and I'm going to become multimillionaires. Like that never happens.
Yeah.
Like never happens. So that's penny stocks. And IPO stocks, very similar situation. Now with IPOs, a lot of IPOs, there's this whole phrase, just because you can doesn't mean you should. Just because you can go public doesn't mean you should. Now, a lot of these companies, they typically run, and it's not always, but I have to point a finger here, but there are situations where venture capitalists are saying no, private equity is saying no, and even banks are like, no, we're not going to give you more money. So where do you go to get more money? You go to the stock market. Unfortunately, most retail investors, they don't know the difference between a good company and a bad company. So they buy in based on hype, and the company ends up raising a bunch of money. And within about 2 to 3 months, they usually fall off a cliff about 90% of the time. The reason is companies that go public, they're now playing with the big boys and girls. Like this is a whole new world, and you better have a strong income statement, cash flow statement, and balance sheet. And after that first quarterly report, we're going to see the truth. And when the truth is revealed, that stock falls off a cliff. So we tell people with IPO stocks, try to wait 4 consecutive quarters to make sure there's a consistent increase in profits. And of course, the scores look good in Ticker, then go into it. But definitely do not, like right now, there's all this talk of Reddit. Like, would I invest in Reddit? Hell no. They don't have enough revenue streams. They're not diversified enough. And there's people hyping it up like this is going to be the IPO 2024. I'm like, do not lose your money. Do not go into that stock. But we see it all the time. There's always hype every year of some new IPO and nope, try to avoid it.
Yeah. So for somebody who isn't in the stock market, and I'll even say, I'll give myself an example because I know that I need to diversify more. I used to I was in stocks and I still have money in stocks, but I don't actively do it I got into real estate, and that was 100% of my focus, and that's how I built. But I have cash flow from my holdings company. I have other investments that I've made. So now I'm building up cash that I usually make investments with, other real estate investments with, but probably need to invest more in stocks and diversify a little. For somebody like me, what would you say would be the best approach? So I'm 32 years old. What would you say would be the best approach? And I think I know where you're going to go with this, but I want you to reassure me. What would you do? I'll give you, say I have a nest that I'm going to allocate $100,000 to this right now that I want to play with. What would you do?
100%. I want to take a step back here just to give context, and then we can dive in there. I'm not going to give stock recommendations and advice. I'm not a financial advisor, but we'll get pretty close. Yeah. So to put it in perspective, let's say you look at like I'm in the Midwest, I'm in Milwaukee area, average home price is $250,000. If you buy a home today, can that home go to $500,000 in the next year? Rare chances. However, if you buy a stock for $250, can that stock go to $500 in the next year? If it's the right stock, it's got great financials, multiple revenue streams, scalable revenue streams, the right CEO, it can most definitely go. And this is night and day difference. You can build your wealth significantly faster with stocks than real estate. However, real estate has the advantage, which you're taking advantage of, passive income or somewhat passive income. You're creating income every month. Stocks don't have that. It's compound interest building into itself. So diving in, you got 100K. What I would do is I would, of course, start with Ticker, get educated, then of course, 14-day free trial, and kind of work your way through the onboarding, start to identify some stocks. The watch list tool helps you get focused with a few stocks and then you run with it from there. But the idea is build up a watch list of about 15 to, I would say 15 to 20 stocks, and then start small because it's all about building confidence. And it sounds like you have a little more momentum than most people because you've been there, done that, you've bought stocks before. It sounds like we get a lot of people, like 80% of our audience are complete beginners, which is good. And we teach them you want to buy 1, 2, or 3 stocks your first month, and that's it. Your objective is not making money, it's building confidence. And then as you become more confident, month 2 or 3, then you just pepper in more dollars. So you've got 100K, I'd say I would probably start with like maybe $1,000 to $2,000 the first month. And then the next month, maybe ramp it up to 5,000, then invest 10,000 that next month and work your way up the ladder from there. But pick those 10 to 15 stocks out of your list of 20, let's say, and that's your limit. Don't buy any more. You want to find 10, and then you want to keep buying more over time. And then what I would do is always I'd probably keep about 50,000 set aside as dry powder cash and get ready to attack when that market pulls back. Because as you heard me and I saw your reaction on your face about the guy, a plumber, turned 100K into 2.5 million. Keep that money set aside because the market pulls back. You want to put as much of that into the market when the market crashes, and then you're going to make a ton of money for sure.
Yeah. So when it does, let's just say when it does, those indicators, because you're going to have more than one that you're looking at. What are those indicators that you're saying? Or you want to, like, for instance, some stocks are going to drop more than the others. Is that kind of let's just say you're looking at 5 stocks and they're in your watch list to dump money into for that day or for that, whenever that happens. What are those indicators you're looking for, or numbers, or I guess I would just say numbers that you're looking for to deploy in that one versus the next, therefore?
Oh, so you're not referring to stockpiling. It's just like your DCA, your dollar cost average you're buying every month.
No. As the ones, let's just say you're watching 5 stocks for your stockpile, that your dry powder that you're holding. For those, you're waiting for the dip, you're waiting for something to happen. What are the indicators that you're looking for? This one just dropped 20%, and the next one dropped 30%. Is there a reason why you wouldn't pick the 30% versus the 25%? I know it's probably based a lot more metrics than that, but is there a rule of thumb that you follow on that?
The best answer is don't overcomplicate it. I like what we teach in Ticker is if a stock goes down 10% over 7 days, right there is a good opportunity. Now, if it's 8% or it's 13%, don't split hairs on this. You got yourself a stockpiling opportunity, get in. Now, when you have a bigger crash where the market, the S&P 500 really drops, let's say 10, 20%, your individual stocks are going to drop a lot more. So it's going to be like a heart attack moment. Oh my God, take the wind out of your chest. But you got to realize this is a good thing in these businesses. Like, for example, Apple, Microsoft, the stocks I hold, no matter if we have a recession or not, they are not slowing down. They do not care. They're going to keep driving forward. So that's why you got to think about the business, not the stock. So be prepared for those moments. You've got those 5 stocks, let them drop. They're going to drop 30, 40, 50% while the market's dropping 20. And you're going to think, oh my gosh, this is insane. I'm losing so much money, but you do not sell. You buy more at those instances. And if you can train yourself to do that once and do it twice, it becomes a lot easier thereafter.
Yep. I watched it with crypto coin. It was the last I bought. Funny enough, I actually bought back in 2010. I want to say, yeah, I think I paid, I can't remember 2010, 2011, but I paid like $34 a coin, I want to say. And I had maybe $200 into it, but sold it a couple months later, I believe, or something like, oh, I know. I don't, yeah, exactly. But I think it was
Sure.
2020. I dumped some money, bought a few coins into it, more towards the higher point of the market right before it dumped. And I said, I didn't lose money. I didn't make money right now. And I haven't sold since. I deleted the app and I haven't looked at it since. So I still have money in there. I don't know how much it is or what it is, but I don't care. I'm not going to look at it for another 10 years probably. So whenever.
Yeah. Real quick there, because I know it can be very tempting for people to look at crypto the same as stocks. Now, crypto, we always tell people, this is in our education as well. Crypto is not a stock because it's not a business. It does not have an income statement, cash flow statement, or balance sheet. So you cannot calculate where it's going. We can calculate where stocks are going because we have the data. With crypto, you cannot. Some people they may argue you can use volatility. It's highly speculative end of the day. So we do tell people, and I know large institutions say this, it's a round number, around 5% or less of your net worth going to crypto, but be careful. We did see people lose their shirts because they'd take out a second mortgage on their home and put it all in crypto, and then it fell off a cliff, and you just lost a fortune. That was stupid.
And as simple as somebody changing their mind, higher ups changing their mind, or putting regulations in place that could literally demolish.
That's it. 100%. Yeah, you nailed it. That's it with crypto. And then with pharma stocks too, can be highly speculative because one government regulation can change. You can cut a share price in half overnight. So I tell people, be careful with those overpriced, those red stocks in ticker. And a lot of those will contain a lot of pharma. But then of course, I was talking with a guy yesterday, but this one pharma company, they got a share price around $5, but they're working on a new cancer drug. And if that becomes approved, it could go to 50. I'm like, all speculation. This is high probability of losing money. Avoid it like the plague.
It's hard. I'm sure most people want to hit those big legs, those big 100% returns and stuff. But it's the people who, like you said, Warren Buffett, it's value investing over time is when you get your interesting, your big hits.
Yeah. I'm talking to a guy next week who Palantir, of course, they were at like $7 or $8 and now they're over 20 and the guy sold it at 14 and he wants to know why he did that. And I'll be walking through emotions in that case. Don't listen to the news. Don't listen to the media. Look past all that. Look at the business. But yeah, people are trying to time that entry, time that exit, knock it off. That janitor example I told you, again, guys making minimum wage, portfolio of $8 million. How did he do it? You buy every month, really boring business. He was holding GE and Johnson and I think CVS Health for the 80s and 90s. These are not exciting business, but the discipline of buying every month and letting compound interest do the heavy lifting for you, that's where you make your money. It's not the speculative time my entry of some piece of junk stock that's going nowhere tomorrow.
No, for sure. But Sean, we're coming up here on an hour now. Where can people go to learn more? I know we have Ticker, of course. Where can people go to learn more about you?
Yeah, Ticker is the number one spot, tykr.com. Otherwise, go to my LinkedIn. I am actually quite active on LinkedIn every day. So that's the other place.
Sean, I appreciate you coming on today.
Really appreciate the invite. Thanks, Dylan.
Hey, if you're still listening, hopefully you got some value out of this or amusement. Either way, I really appreciate you for listening. My goal with this podcast is to build something of value while also showing others that it's possible to do the same. And what I mean by that is I'm not perfect at this. I fumble, I stutter, and I just want to show that it's okay. If you've been putting something off, this is me telling you to go for it. So I need your help in growing this, and there's two main ways a podcast grows. One is through ratings and reviews, and two is through word of mouth. So I can only do it with your help. If you can leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as post this to your social, it doesn't grow without you. Thank you. Talk to you all next week.